Okay, welcome back, everyone, and a special welcome to Paul, Abby and Gil from the Christchurch City Holdings Limited, who are here to provide a strategic update publicly and discuss the draft statements of intent in a public excluded session a bit later on. After the strategic update, we will move into public excluded for the remaining items. So welcome and fire away.
We will work through. So I guess the first is just the background to why we're here. The SOIs are part of the local government act requirement.
Sorry, our mic's on.
Sorry. Apologies. So yeah, the SOIs are prepared in accordance with the Local Government Act. We're following that process. The draft SOIs were guided by the enduring statement of expectations, which we received first in, well, actually it was dated in 2021,
original,
but yeah, the original that was confirmed in late 23. There's a requirement that we align the SOI to the Council's strategic priorities, and we have worked on that in presenting this draft. The letter of expectations for FY25 we didn't receive until the 29th of February, and with the SOI due to you on the 1st of March, that wasn't part of what had been contemplated in the draft SOI, but that will inform this discussion and further refinements of the SOI. And then the other piece of context in terms of the background to the preparation of the SOI was Council's decision in December and the request that we implement the enhanced status quo option. So what I'm going to do is just take you through the exactly what that meant and the implications. There were a couple of questions last time we were with you, and we thought it would be helpful to lay this out. So the enhanced status quo is effectively an evolution of the approach to managing the council's investments through CCHL. Back in December 22, there was an instruction that CCHL moved to more active ownership. And then, of course, the decision in December of last year effectively asked CCHL to move ahead with implementing that. So in terms of the scope of that option, if you like, as it was then and mandate as it is now, what that means is that the asset portfolio remains pretty much as it is. Any ability to transact is covered by the council's significance and engagement policy. And what that means is that there's limited ability within that group effectively to support future capital needs. The commitment that we've made is to deliver a fair return to the shareholder, recognising that there are, however, competing needs for the returns that are made by the group. The intention with the enhanced status quo model is to enable that by a stronger focus on operational improvement and capital management and effectively more active management of the subsidiaries. So in terms of the implications of that, the requirement is effectively that we balance what it means to be a long-term owner of significant infrastructure in Christchurch with the requirement from the council for greater certainty over dividends. This is complicated by the fact that there is a higher cost associated with being an owner of infrastructure assets, and there is limited flexibility provided by the capital constraints to meet either the future capital needs of the subsidiaries or indeed the certainty that council is looking for in terms of dividends. We've identified to you previously that there is a limited opportunity for us to increase dividends. In fact, we have no upfront capacity to do that, but over the 10 years that we talked about in terms of the LTP that is covered by the enhanced status quo option, there is an opportunity over that period to increase dividends. What that means, though, is that there is no new investment opportunities that are contemplated within that budget, and that co-investment might be required if we want to ensure that we reflect the responsible investment approach and objectives in relation to the infrastructure assets. So that's the enhanced status quo option. I guess what that brings us to is that this is a particularly important SOI for CCHL. We want to reflect the investment objectives that the council set for us and that were developed through the strategic review process. And what you'll recall is that council were clear with us that they wanted our approach to ensure that there was an intergenerational focus with a focus on the need of both current and future generations, that you wanted us to support regional investment with a focus on Christchurch and the Canterbury region. You were looking for sustainable dividend growth, and you wanted us to reflect a prudent risk appetite. So our commitment to be a responsible owner requires us to also think about what it means to be an owner of infrastructure assets. And indeed, each of the entities that we own is obviously a critical part of the Christchurch and Canterbury region. We're also thinking about and conscious of council's direction that we maximise dividends. With no access to new capital, there is a challenge to our ability to do that. And we also obviously have an operating context, if you like, which is framed by increasingly higher costs of being involved in infrastructure business, the fact that any improvement in revenue from the entities that we own is dependent on regional growth. For us to improve profit from those entities, we need to really focus on tighter cost control and capital management. And we noted both in the SOI and actually through the strategic review process that the challenges that dividend flow may be uncertain, and that with the debt that CCHL is carrying, we have limited ability to smooth the volatility associated with that dividend flow. So we really see this SOI as being where we need to start addressing some of these competing challenges and laying out how CCHL will address them. So with that, I'm going to ask Paul to step us through the remaining slides.
Thanks, Abby. So as Abby noted, the draft SOI was prepared without the benefit of the letter of expectation. So we acknowledge that there's a bit of work that needs to be done over the next 2 months before we finalise it to accommodate some of the direction that's provided in there. So what we've done is we've broken down the next few slides into kind of 2 components. So firstly, how we are seeing the strategic direction that council have provided within the LOE, and then the second set of slides will deal with the council's investment expectations. So I guess our kind of highlights or key observations from the draft LOE is that we believe it does provide us with clear direction. You've asked us to implement the enhanced status quo option. As Abby noted, we see this as an evolution of the existing operating model for CCHL. So we already now refer to it more as active owner than enhanced status quo. You asked us to align the SOI to council's strategic objectives. We've reviewed the strategic framework. There are 3 objectives within that: the objective of reducing emissions, managing ratepayers' capital wisely, making sure we actively balance the needs of generations, as 3 objectives that resonate with us. And ultimately, those investment objectives, those strategic objectives did inform the investment objectives that you landed on during the strategic review program. And you've also asked us to think about those strategies in the context of developing a responsible investment framework. And it is planned that we'll have a workshop on that. And I've got a slide which talks to that from a high level in a few minutes. The other thing that you've asked us to reflect on is a desire to provide more insightful reporting. This is something that we are 100% aligned with you on. We want to build on what we think was the stronger engagement between CCHL and council that was established last year. A function, I think I've counted 13 workshops that we had on the strategic review. But more importantly, over the last 18 months, we have committed to being more open and more transparent. We don't always agree on some of the matters that we discuss, but we're not going to hold back from being open and transparent with you, and we want to continue to build on that this year. We also want to spend more time facing the subsidiary. So last year we had a lot of time facing council, just as the nature of the work that we were doing, and this year we want to spend more time as an active owner of the businesses that we own. Less and better is the direction that we're getting from our board. So we want to deal with the information that is most meaningful, most impactful. That doesn't mean we don't meet our statutory obligations. There is a list of things that we need to comply with. But in the way that we report, we do want to focus on the things that are most material. And that will include providing stronger forward guidance. So we often find that when we come to meet with you, we're talking about things that happened 3 or 4 months ago. What we want to be doing is focusing on what happens next. The other thing that you've asked us to do in terms of strategic direction is strengthen some of the insurance frameworks. And again, this is something that we are aligned with. So we believe it is time to move back to an appropriate benchmarking of both the group or the portfolio and the individual assets themselves. We'll be having discussions with the subsidiaries around what that means. So we want to make sure that we actually land on what we think is an accurate, truly representative benchmark for those businesses, because obviously you can pick numbers to suit yourself, and use that as a mechanisms to hold us to account for the performance of the group and the individual assets for the performance of their businesses, and also to evolve a group risk management approach as well. So then, as we become a more active owner, there are things that seem blindingly obvious to us. So as you are well aware, it's becoming much more expensive to insure infrastructure assets. That tends to lead to decisions at an individual entity level to self-insure, to hold that risk. But of course, when you've got 4 or 5 or 6 businesses all deciding to self-insure, that bubbles up to one level, which is us. And ultimately, if it becomes too much for us, it bubbles up to the 0800 Uncalled Capital phone number, which is you. So we do want to evolve that group risk management approach as well. So we are aligned on that. We are evolving our strategic framework. So, it's a terrible slide, obviously, for a screen, even a big screen, because there's a lot of information on it. But it is really important that as we move to becoming a more active owner, that we're making sure that we do things which add value to the group. So we're not looking to substitute things that the subs are already doing. We're not looking to create new process for process's sake. So we have to be really clear in terms of what we actually use as an input, which we report on our 4 capitals, what we do with those capitals, and then for what intended purpose. As we talk about being a more active owner, that fits firmly into the what we do category. And the other thing I guess will come to play here is also where we go with responsible investment framework. So those are the next 2 things I really want to talk about in a bit more detail. So what do we do as an active owner, and how is this different from what CCHL has done in the past? So an active owner, by definition, is seeking to have more influence over the strategies, decisions, and activities of the businesses that you own. And the first thing you need to do when you're deciding to do that is decide what your approach as a parent is going to be. And in broad terms, you can take a hands-off approach, which is the CCHL model of the past, and leave the businesses with full operational independence, and you aggregate things that they produce, particularly dividends, but also information, consolidate it and send it on to the shareholder. The other extreme is you're hands-on and you're actually setting their strategy and having more insight into key personnel appointments and other things. We're going to move somewhere in the middle, and the 2 bits in the middle focus on financial sponsorship, which is what we do through our group funding facilities, and strategic leadership, which is not something that CCHL has done as much of in the past. And again, this is just focused on the things that are most important to us as the owner of those businesses. And I guess if I could use an example of that, sustainability is one area. So we are a climate reporting entity. It's really important that the group is aligned on its approach to sustainability, and we need to provide leadership to the group in terms of what that actually means. And the other area is health and safety would be another example where we have high expectations in terms of wanting our businesses to be safe places to work. We want to ensure there's a strong culture that exists around health and safety, and it's an area where we feel like we can provide leadership to the group. The second thing is, okay, what do you do? How do you actually apply that? And this is where probably some of the more substantial change is starting to occur. So one is, I guess, taking a view that we control the capital across the group, and we want to make sure that capital is used in an optimal fashion. That doesn't mean that the subsidiaries don't get to make decisions in terms of how they use their capital. We're just really clear about how much capital they've got to use. And we'll make decisions in terms of where we think priorities exist across the group, how that capital will be allocated. So developing a capital allocation framework is a new instrument for us. It's something that we'll be working with the subs on in the next few months to land. The existing approach to group funding fits within this, and then the new approach to benchmarking will fit within that category as well. The other bit is making sure that where we've got expectations around alignment, it actually happens. So in general, we'll allow or assume that where there are operational synergies, that the subs will talk to each other, and they'll be looking for opportunities to identify and unlock and extract value from those synergies. But there are areas in terms of where we want to have a positive environmental or social impact, that we might feel that we need to make sure that we're taking a group-based approach to that. And then also where there are strategic synergies. So one of the things that exercises our mind a bit, for example, is that at the end of the day, the customers of our businesses are pretty much the same people. They either live in Christchurch, or they visit Christchurch, or they trade with Christchurch. And yet we've got 5 or 6 businesses that all approach those people a bit differently. So are there opportunities to take a kind of more strategic or ecosystem-based approach to how we think we interact with those customers? I mean, you can reflect yourself. You probably touch our businesses 5 or 6 times a day, and the way you interact with them is different in each circumstance. So this pushing harder on the strategic alignment piece is something that's new for us as well. But equally importantly, at an entity level, making sure we preserve operational independence. So at the end of the day, the biggest point of value we are likely to ever create is we appoint good boards who appoint good people. And as long as everyone's really clear about how much capital they've got, what the strategy is that capital is intended to support, what our approach to risk attached to that, the use of that capital looks like, then we should just let them get on with running their businesses, and that's what we still intend to do. So that gives you a bit of a taste in terms of how we're thinking about our approach to becoming a more active owner. And then the other thing that you've asked us to look at is, which we are going to have a workshop on, is a responsible investor or responsible ownership framework. So, and this is something that I think that we can all get aligned to. It's certainly something that resonates for us. And what these frameworks do, and they're about a decade old now, so this is not new news, but they do rethink the way you approach ownership of infrastructure assets. So the old approach, which is, I guess, the nature of our portfolio, is the hard physical assets, which you own for commercial reasons. So the objective is to extract some dividends and provide some public good. That's why you retain ownership. But the infrastructure universe is expanding dramatically in the way that people think about it, and is embracing more and more digital infrastructure, green infrastructure, social infrastructure, which better reflects society's changing needs and expectations. So if we're going to move into a responsible investment framework, we are going to think about how we might or what we might consider to be strategic infrastructure assets in the future. And in broad terms, there's kind of 4 elements to this. So one is stewardship. So that's that commitment to preserve and enhance the long-term asset value for ratepayers, both as owners and users or beneficiaries of the assets and services. And that is the hard infrastructure asset space. So that absolutely stays very much part of the picture. The second kind of pillar is making sure you integrate ESG into your decision-making frameworks. And for us, there's kind of 2 things that are important here. One is there's a lot to integrate from an ESG point of view. The list is enormous. So what's really, really, really important is making sure you understand what is material to you and what's material to your stakeholders. So we've got an exercise underway at the moment where we've reached out to a range of stakeholders, including you as the shareholder, through a materiality assessment framework to identify what you think is most material for CCHL, because that will inform how we think about integrating ESG into our decision-making processes. And then the second step in that is making sure that at a subsidiary level, those priorities or that materiality is embedded into decisions around how capital is used, what your operating structure looks like, and the allocation of resources within your operating structure, and then ensuring that scenarios that you're looking at within your business include consideration of the risk of obsolescence, because that's one of the material risks that tends to emerge from integrating ESG into decision-making processes. The third pillar is impact investment. So this is where you undertake new investment for a specific and positive social or environmental benefit. So an example of what CCHL has looked at in the past is social housing. So the asset itself is long duration, which all of our assets are. It does have relatively steady cash flows. It doesn't seem like this country is going to solve the need for social housing anytime soon. So there's going to be a proven demand for it that does have reasonably reliable cash flows attached to it. And it has a positive impact if we're helping to give people accessibility to social and affordable housing. So that would be an example of impact investment. And then thematic investment would be the last piece, where you're looking at specific opportunities within sectors that in this context would be more specific to Christchurch and Canterbury, and what are the things you want to support in terms of creating the right platforms or enabling future growth of Christchurch and Canterbury, which could be in more diverse or new sectors than has been the case in the past. So obviously that appeals as a framework that has a number of pillars attached to it. But I guess the question that we'll have to address as we approach the workshop is does council significance and engagement policy actually enable this approach? Because if the capital is tied away and is not to be accessed, then that really does limit us to 1 and 2, the stewardship and integration of ESG, and limits our ability to undertake impact-based investment, and certainly thematic investment is completely off the table at this point in time. So that kind of deals with how we've, I guess, reviewed the strategic direction that you provided to us in the LOE. So the other bit is the investment expectations, and as we've indicated previously, we do see some tension in these expectations. So on the left-hand side, you've got objectives which do require us to continue to invest capital. So we obviously want to preserve the value of these existing assets, which means that we need to be able to continue to invest in maintenance. We need to be able to increase the level of investment in resilience, because the cost of resilience and the definition of resilience is changing, and we need to be able to continue to invest in BAU growth. If we don't do those three things, then the reality is that we face an increased risk that these assets begin to wither on the vine, that they just get starved of capital. And ultimately that's to the long-term detriment of the assets, and obviously to the long-term detriment of the city and region. You've got sustainability objectives, which are to be net carbon neutral by 2030. I think we've been pretty open. That's an incredibly difficult, if not impossible, objective to meet. So certainly we don't have the investment, the capital that would be required to invest in accelerated decarbonisation within our businesses. So if we were going to be net carbon neutral by 2030, we'd be well into offsets in 28, 29, which again, we don't have the capital for. So that's a particularly challenging expectation. And then you've asked us to look at other things. So strengthen pay equity, explore the opportunity to build new platforms around shared services and look for other synergies, make sure we align to the city's economic ambition, so the regenerative economy, and remain open to good ideas. So again, all of those things require capital, either CapEx or OpEx to support them. It doesn't mean that we aren't aligned to those as objectives. We absolutely are. But that needs to be considered, or how we prioritise that needs to be considered in the context of the right-hand side of the equation, which is your expectation that we will maximise dividends through this SOI period. So you've identified a very clear priority that you want to see income over other forms of use of capital over this next 3 years. So that's a very strong operate for profit direction, which is sweating the assets harder. And there's also a direction in the LOE which says that council will not provide equity or debt. That last bit's a bit challenging for us. Funding to CCHL over the next decade. So that is an exclamation mark, if you like, on one of the outcomes of the strategic review, which is that we did face a more capital constrained outlook, and that second direction means we absolutely have to live within our means. So those are I don't want to say in conflict, because there is timing considerations to those. You can still have a positive long-term intent to deal with the elements on the left-hand side while you address some short-term realities. But there is obviously, it does create points of tension when it comes to making decisions over the next few years. So I won't spend too much time, because I appreciate we want to give you a bit of time for questions, but this is kind of this next two slides summarise how we've approached these issues in our SOI, and we've begun to engage with council management and particularly Linda in respect of some of these, to make sure that we provide a clear understanding of what our approach is, and you've got clarity in terms of what that approach looks like and what it means for council. And that these are all included in our SOIs and the KPIs that are identified within that. So what we've done here is we've just broken it down into the four capitals, so financial, intellectual, social capital, and how we approach our natural capital. So given that we are a bit time bound, I'll stop there and leave it open to questions.
Okay. Thank you very much. Councillor Kewen, please. And I've got you, Celeste, you're next.
Yeah, quite frustrating to listen to, most of that. It'll be really nice to know the cost of all of our overreach and direction and intentions and everything else. Like, we want to be green and we want to go carbon neutral, and we want to pay really high wages and want to give all the staff a back massage on a Friday afternoon, and all of those things, all these expectations that we're trying to put on the organisation. Whereas if you're just good to your staff, or you're good to the environment and you balance the books, you're doing the best you can, like best decision for the job. But we seem to be overreaching a lot. Can we get a cost on that? Like you say, the carbon neutral one, because it's virtue signalling and not actually real, it doesn't balance economically, and so you shouldn't do it. But because eventually you will be able to do it economically,
yeah.
But when you try and take 5 bets for one of them to maybe pay off,
yeah,
it doesn't work.
Yeah. So I think there's probably 3 elements to that for us. So one is the first thing we have to get right if we're going to be a responsible owner. So having taken a decision that you want to retain control of these assets through ownership as the lever that you want to exercise, rather than the investment governance framework that was part of the active portfolio management option. That only works if you can meet your obligations as an owner. And that's the thing that we are probably struggling most with, that the strategic review did demonstrate, that we don't have clear line of sight that there will be all the money we need to meet those obligations. And that is, again, it's maintenance, it's resilience, it's growth, but it's also decarbonisation. It's dealing with digital transformation. It's dealing with changing consumer preferences. So that creates the risk of stranded assets, if you like. So we can build up what that capital equation would look like, but I can tell you it's just going to be a big number that we don't have enough money to fund. Then you kind of, I guess, break it down in chunks, which is what are the subs already doing, because they are doing a lot, and so it's not like we're never going to do any of these things. But if we take pay equity as an example, so the ambition is one that we can easily support. I mean, the idea that workers have not benefited to the same extent as shareholders over the last 30 years is something there's a lot of clear evidence around. But if we are going to strengthen pay equity, and
what was that last statement? That workers haven't benefited?
Yeah, if you accept the idea that profits to shareholders have grown at a far greater rate than salaries and wages over the last 30 years, there's lots of evidence that says that is the case. It's starting to change.
From our organisation?
Oh, no, just across.
I was going to say, I've seen the profits of these. I mean,
yeah, but the idea of strengthening pay equity is effectively that you're lifting the labour cost structure of your businesses.
But you can only do that for productivity growth.
That's right. You need productivity growth, or you need bigger businesses. So there needs to be growth in their underlying businesses to
Productivity growth can come in many ways, shapes, and forms.
afford that. So you can break down kind of more specific elements by an individual cost piece as well. And then the last bit of that equation is what do we do as a group? So what are the things that are most material that we would then identify as things we want to exercise? I think these conversations will be flushed out in more detail when we have that workshop on responsible investment.
Yeah, because I think part of the responsible investment, and it's not covered off there, is not, I don't know, not buying into a bomb factory or guns or petrol or any of those. And then different people have different perspectives of that, because someone like Yanni might not like us being part of McDonald's, for instance, and then you've got some people saying that if there's one shareholder from Israel, we shouldn't buy that either, and so on and so forth. And so the list gets pretty long.
No, that's right. That's where the materiality assessments are really important for us. That's the work we've got underway at the moment.
Right.
Thank you. Councillor Donovan, you got your hand up, bud?
Sorry about that. Paul, I just wondered if you could explain a bit more detail about the process to get feedback for the responsible investment framework.
So in the letter of expectation, there is a request that we schedule a workshop on it. So we'll be working with council management to identify when that workshop will be. So what we'll do in advance, we'll circulate some discussion materials for people to reflect on before we have that workshop.
So you haven't circulated those materials yet, because I think you said that you had, and I was a bit confused if I'd missed it.
No. Sorry if I said that. That's not the case.
And I guess the scope of that would consider things like reputation of council. So it's quite broad, isn't it?
It's very broad. Again, I keep coming back to the fact that this materiality assessment piece of work we've got underway at the moment is really critical for us, because it helps us focus on the things that are most important to CCHL.
Yeah, right. That'd be good.
Thank you. Okay, so we've Councillor Johansson.
Do you want like specifics on the SOIs now, or?
No, there's a mechanism to provide feedback over the next month.
Right. Okay. I mean, just at a general level.
Yeah.
I was quite interested in the diversity on the boards and and within the companies, and how we're like kind of progress around that. Like, yeah, I know you've done a lot on gender, but I still don't quite know what's happening with that other assessment of diversity.
Well, one of the issues that we've had in terms of non-gender aspects of diversity is capturing the data. So we've, as part of the skills matrix work that we introduced last year, that now enables us to capture data directly from directors in terms of other aspects of diversity that they might identify with. So that work's currently underway. As we mentioned at the last session that we had with you, we made, I think, 17 appointments last year under the new appointments process that you put in place, and 50% of those were women. So I feel like we're making progress in terms of the gender diversity. I think, as you will probably know from reading the bios and the descriptions that we have provided to you in relation to those director appointments, that we have introduced additional diversity aspects, but we don't have data on that at this point, because it requires people to individually provide us with that data, which we are collecting through the skills matrix work.
Right. And are you also doing that for the senior management of the companies as well?
Yeah, a number of them are already collecting that information. So yes.
Just kind of interested in just the whole idea of like synergy, right? Like looking at those opportunities, maybe the port and the airport going into one sort of port, maybe Orion or Kinetics and Enable. Like, is anyone looking at kind of, because I sort of get confused where we've got to with that whole. I know we've got some amendments in the LTP asking for work to be done around things like, I think, shared services, but I just don't quite know tangibly like what that program is, but I would have thought there's massive opportunity around strategic property across the entire council group, including the city, and also things like a number of the shared services. And you kind of touched on the insurance aspect, but I just don't know how we get visibility of those other work programs, or whether we need to be more directive around it.
Yeah, so I guess if we come back to that strategic alignment piece that I was talking about before. I mean, our job is to provide direction to the subs on that, and then look for opportunities where we think it's appropriate for us to intervene in terms of taking a best for group approach. So, what we've done here, you can't obviously see it in the middle, but we've done a self-assessment in terms of where we think we are in respect of our own ability to give effect to each of these tactical levers that exist, and right now that synergies piece would be under-resourced from a CCHL point of view, and probably from a group point of view.
Is this on? I couldn't find it on the.
No. This is our framework that we're developing. Ultimately, becomes part of the business plan that we take to the board.
You have got the slide
All right.
pack, though.
All right.
You've got the slide pack. Yes.
You know what it's called? Because I sorry, it's not on my hub. So
Okay. Sorry.
See you.
the fourth one down.
Okay,
so-
thank you very much. That's enough questions. We'll move into the PX bit now, public excluded bit. So we'll just wait for a minute until everyone's turned the